Okay, guys. Hope I'm coming in clear. You can see my screen. Welcome. This is, I guess, the 5th or 6th AIN Asian Investors Network roundtable or speaker series. Today, we're fortunate enough actually to have Eng Taing, CEO and founder of Touzi Capital. He's got a really rich background, which he'll tell you about in just a moment. But just to give you a little background on AIN, to kind of orientate everybody to what we're about. We're essentially a community of pan-Asian, Asian American and Asia-focused investors. What we're trying to do is build a community that is educational in the spirit of learning and sharing. And we try to make sure that the quality of the conversation, quality of the research, and quality of points of views are high. And that's one of the main missions of our group. And I'll just do a quick next slide here, just so I get a chance to do that. There's actually quite a number of folks on the phone that are part of the team. I guess we're kind of the core moderators, myself and Sam. Sam will get a chance to introduce himself and kind of MC this because he has a deep background in real estate as well. My background is in tech and startups and venture. I was, well, I don't need to tell you about my background. We can talk about that offline, but we're kind of the face of the group. And without further ado, I'm actually gonna just pass it on to you, Sam. I'm just put the agenda real quickly up top. And then Sam, you do a quick kind of intro yourself, and then we can get it going with Eng in just a second. How's that work?
Awesome. Thank you for setting that up, Ken. So wanted to welcome everyone to Asian Investors Network. We created this group, as Ken was saying, to provide investors in the Asian community with opportunities to connect with each other, exchange knowledge, and share about investments. So since March of last year, we've actually grown to nearly 4,000 members, and we're excited for the upcoming year. We alluded to earlier that we have a lineup of speakers and topics planned out, and we're really excited to carry that out. I think that you guys will all enjoy our talk with Eng tonight. I will be emceeing this talk because I've been investing in real estate for a long time, and I really want to hear what Eng has to say as well. So with that said, please welcome our illustrious guest, Eng Taing.
Hey guys, thanks for having me. I know we have 20 minutes for this presentation, and I have a lot of slides, a lot of topics. I will try to skip a bunch if you guys aren't interested. But if you do, just because everyone's can talk, just let me know. I will, today I want to talk about real estate and taxes, two of my favorite topics. It's not really updated for 2021, but nothing's really changed in last month. And we got a lot to cover. Probably not gonna cover all. We're gonna go into my background, go into the meat of the presentation on how to pay less taxes, which is probably something everyone wants to know about, and go into some of the finer details of the strategies that probably you've heard of from real estate investors, like Donald Trump, who pays very little taxes. So I'll highlight those as well. So just as a primer, I'm not a tax professional. This is educational entertainment purpose only. I am a real estate investor who used to pay a lot of taxes and don't like paying taxes. And that's sort of my motivation to learn all these things and do these things. So really what I'm trying to highlight here is stuff that I've done, not any CPA's advice specifically. I do have a varied background though, and I want to highlight that because I went to Wharton, did a degree in economics, was an investment banker, Peace Corps, did analytics, joined Apple, did a bunch of roles at Apple, and most recently founded Touzi Capital, where we syndicate and manage private equity funds. We recently reached $100 million in asset under management. But throughout the whole time, I have been investing in real estate. And it's something that, I've been investing since 2009, good year to invest in. And I since learned many ways to use real estate as a great way to shelter my taxes. A little bit about my personal history. So I bought my first triplex when I was 23. It was in LA. I bought it when I was in DC, so I actually bought it out of state. And I bought triplex and quadplex every other year or every year for 7 years in LA until it became too expensive and not cash flowing and overly regulated and all that stuff you hear about why you don't want to invest in California. Invested in multiple passive deals as well. And then I started buying my own, and then I started syndicating. And I do mostly senior living now and operating zones. I think everyone's general wealth strategy should be to potentially, when they're starting out, save money, right? This is how you start earning your money, you start saving it, and hopefully you're investing with that savings. And then you can only save so much. You got to start earning more money. Hopefully you're doing it at the same time. But then when you start earning a lot of money, you say, oh shit, I'm paying a lot of taxes. Then you got to think, I should figure out how to reduce your taxes. Your number one expense in life. For those who are lucky to pay a lot of taxes, it will be your number one expense in life. So hopefully this will illuminate the last part. So how to pay less taxes. And it's really more about how to keep more of your earnings. And when it's about taxes, it's all about the facts. You have to rearrange the facts. So let's talk about order of operations. Go into some basic concepts here. When you're an employee, you get paid, you pay taxes, and then you spend. That's very typical. When you're a business, you get paid, you earn revenue, you spend money, you have expenses, and then you pay taxes on the net profits. So a little bit better arrangement. When you're an employee, a lot of times what you try and do essentially is rearranging. So I'm going to keep highlighting that. The order of operations. You're trying to move post-tax money to pre-tax. 401k, HSA, FSA, probably you guys have heard of those or have one. This is all about shifting tax, your income or your expenses or whatever in different arrangements. It's still the same facts, it's just rearranging it. And there's a third tranche here, and that's investors. Employees have that business we talked about. Investors, they spend money or they invest, then they get paid, and then they pay taxes, although most times they don't. Let's talk about how that works. I think one of the most powerful ways that real estate investors use to defer or to not pay taxes or limited taxes is deferrals. And deferrals is the number one way most people use to reduce and minimize the taxes. 401ks, right? So deferral strategy, you defer and you're putting pre-tax money in, you're paying taxes later. Real estate is all about deferrals. So let's talk about 3 specific points of deferral: depreciation, 1031 exchange, and opportunity zones. So with deferrals, one of the things I want to highlight concept is opportunity costs. I'm sure most of you guys are aware of what opportunity cost is, but I just want to highlight that most people don't think about it when they do a particular action. The fact that you don't have to pay taxes on $100,000 for 10 years, for example, and you could probably put it into something that yields 12% a year compounded, make $310,000 by the end of 10 years, and then pay the $100,000 of taxes owed in 10 years, you've netted quite a bit of money. So that's about deferrals, and there's lots of strategies with real estate that defers taxes to the future. Another part of real estate is depreciation. And depreciation is about deferral of taxes. And I'll go into depreciation a little bit more. But I also want to highlight that depreciation not only defers taxes, but it rearranges or changes the classification from, when you're sheltering ordinary income, passive income, rental income, you typically pay ordinary income from that, 37% top and marginal tax rate, federal. But when you defer it, you're shifting it to long-term capital gains, capped at 25%. although it's mostly 20. So not only are you paying it in the future, but you're shifting it to the future, and you're changing the rate that you pay it at. Final point and topic thesis here is that inflation erodes future payments, right? So just because you owe $37,000 now, and by the way, you're saving it because you're owing $25,000 in the future, inflation at 2% is going to erode that. This is why I love real estate. I have so much debt, it's crazy. I have probably $70 million of debt, and they will all go down in value over time. Every time that this inflation or crypto goes up, or the gold goes up, or this the sliding dollar, which is happening, my debt that I owe is less, but my assets go up, my debt goes down, and I'm even paying the debt usually. I just it's cheaper over time. It's great. So depreciation is one of the major ways people use to so for some reason I'm one have to admit people. I'll just be a little bit distracted. So depreciation is one of those ways that people and real estate investors use to shelter the taxes. And how does depreciation work? If you buy a property for like $1 million, you essentially can depreciate it over 27 and a half years for residential, 39 for commercial, and take that portion of the non-land value and take it as a loss. That loss is an expense on your P&L. An expense on your P&L reduces your taxable income. So when I buy something for $100,000 or investing for $100,000 and I'm making 12% cash and cash, which is typical, or I mean, at least with some of my investments, I can also depreciate it and get $12,000. This is very typical of the expenses, and essentially wash out the losses or wash out the gains. So on $100,000 of tax of investments, I'm actually putting $12,000 a year into my pocket in my bank account. There's no tax withholding on it when I get the rental income or the distributions or dividends, whatever it is. But at the end of the year, I report a $12,000 gain, but also $12,000 loss through a K1 or whatever Schedule C, and highlight the fact that I made no money. Even though the depreciation is actually just a reduction in the cost basis. So you actually owe in the future, which is great. I would love to owe everything in the future. But it also makes it that your tax present value is negative or neutral, sometimes negative. I might skip this cost segregation bonus depreciation. This is new law to 2017 that allowed people to do cost segregation study, which is not new, but essentially what you can do is you can take a portion of an asset, take around 20% of its value, and instead of depreciating over that long period of time, take it in 1 year. That essentially makes you grab a bunch of losses the first year. And why do you want a bunch of losses? Because you can write off all other passive income. So there's a huge net present value to this. And in this case, this is actually a property I bought last year where I did a cost segregation study. Without the cost seg study, over 5 years, I would have taken a $549,000 loss. But with the cost seg study, I got a $1.5 million loss in the first 5 years. Or really, I got 1.3 million the first year, and I use that very effectively. And here I'm showing that the NPV of it. So when you're investing in sort of like a syndication or like something like what I do, you put $100,000 of gain of investment, you get $12,000 in your pocket, you get around $60,000, which is probably an average. 50 to 60 to 70% is an average of how much you would get in terms of a write-off against your passive income. Remember, there's 3 types of income: active income, portfolio income, which is stocks, and passive income, mostly real estate and businesses. Although passive business, active income is employee W-2. So when you have so many losses and you can't use it, you can carry it forward over time. So that's another benefit as well. and I'll come to a climax on what to do with all these losses. I want to highlight what are the levers of depreciation. Some people know that you can't depreciate land, but leverage is actually a big lever of depreciation. You want more depreciation, remember. You want more losses. You want more deferrals. So if you say you buy all cash, you're essentially not leveraging the depreciation. If you got 20% losses the first year on the non-land value, say the land value is 20%, and you put all cash, then your $800,000 of investment got you $20,000 of losses. But if you leverage it and you put 75% down, or 25% down, you put $250,000 and you got $200,000 of losses. So that's a pretty big ratio. So when you pay more in a down payment, you actually lose that efficiency. You actually want to, I would love to leverage at 99%. I'd love to put no money down. And because the bank does not share in depreciation, it does not take any depreciation. It all goes to you. So when you go lower leverage, that $12,000 example makes $8,000, which now I get paid $4,000 a year in taxes. Like, that's ridiculous. I don't know how you guys pay taxes. Land value is also another lever in depreciation. You can't depreciate land. So with land, obviously, if you're in SF, LA, New York, it's very high, 50%, 60% land value of the purchase price. So when you have higher land value, you have less depreciation. You still got to pay for all that, but you can't depreciate land. So it's another big factor. So this is why I often optimize for buying in low land value areas like Kansas City and buying cash flow properties, which gives me high leverage. Because when you buy for appreciation or low cash flow, it's hard to get as much leverage as I do. So I optimize for this for my investments. Hopefully you guys can as well. Just highlight what you can depreciate, what you cannot. You can depreciate anything that has rental income. You can depreciate vehicles, patents, IP, software. Another cool trick is if it's around December 30th, you buy a Model X, you take 100% depreciation on that Model X, take it against any rental or passive income, business income, and now you got 37% off your Model X. Congratulations, guys. And why I say December 31st is because you got to use it, you kind of depreciate the business value, the business usage of it. And if you use, and it's calendar year, right? You buy it the last day of the year, you spend the whole day doing business stuff, and now it qualifies as full 100% business depreciation. You cannot depreciate your personal property. Although if you rent it out or house hacked, like a room, it gets a little tricky. You can depreciate that. It's just, I'm sure you got to talk to CPA, but cannot depreciate land or stocks or collectibles.
Yeah, pardon me. Are you
go
taking
ahead.
questions while we do this presentation?
What?
Are you taking questions as we go? Just out of curiosity.
Yes, please.
Okay. If you had a question, please unmute yourself and just ask.
Yeah, I am probably not going to read the chat, although I see people in chat asking stuff. So for free for you guys, moderators to also ask me what people ask me in chat.
Sure.
Go ahead, Kevin. Yeah, so I just asked in the chat. I saw your talk about house hacking. So like if I buy like a 4-bedroom, I'm living in one of the bedrooms, can I depreciate 3/4 of the cost of the house then? Like where is kind of like the tricky line here, I guess?
Yeah, you can. So it's same thing as like expensing, a home office. Anytime you use something for business reasons, and real estate is a business, you make rents on it, you have expenses. So you depreciate it. I can't tell, the math's not as simple because of living room and kitchen. So you can't do all 3/4 like Jason said in chat. I'm not a CPA, but you can depreciate. You can't, it's going to be trickier. And I don't know if it's worth it to even try. Although when you buy rental income, by the way, you have depreciation, and if you don't take advantage of it, you don't do it, you will still have depreciation recapture. The government will still assume that you took depreciation the whole time.
Okay, got it. Thanks.
But by the way, if I'm saying anything wrong, feel free to correct me. I'm not happy to get feedback on that.
Okay, so it's just not that simple. Got it.
It's not that simple, but you know, nothing's that simple. You can also like, I would say that I have talked to probably 40 CPAs, and most people are order takers, they're executors, right? You got to think of your creativity yourself. From what I found out from talking to real estate investors who pay no taxes, these are the strategies they told me. Most of them don't house hack, so I don't have an answer for you there. But from the other strategies that I'm referring to, that's how I find people who make millions of dollars pay zero taxes.
Okay.
So you defer and defer, you defer these depreciation. What do you do with it? You got to pay taxes eventually, right? Obviously, you're getting advantage, but you know you can tender exchange, which is the deferral of those capital gains and deferral of the depreciation recapture, which is capital gains. And so when you sell a rental income property, you can tender exchange into something within this parameter timeline. And essentially invest in a rental property, cash flow, take depreciation, and then tender exchange to keep deferring that depreciation or really transferring the lower cost basis to the next thing. And this is something that, you know, maybe some people know, some people don't know, but this tender exchange cycle that I love talking about. You buy rental property, cash flows. It should cash flow. That's how you get money, and you get tax free, which is great. I make several $100,000 all rental income tax free. You tender exchange, and you keep doing it and doing it and doing it until you pass away, and all that cost basis, which is like reduced to zero. Now you've got so much capital gains. If you ever sold, you owe millions of dollars of taxes. When you pass away, it adjusts to fair market value, and no one's left holding the bag. It's amazing. This is why people do real estate. This is why people buy and sell quite frequently, and exchange and exchange and exchange and exchange. And you don't have to exchange every time. You can do a bonus depreciation and cost seg study to wipe out capital gains. Because exchanging every time, basically you're going to accumulate so much losses that you're not going to have anything to do with it. You're going to start earning income now. So a third part of deferral strategies is operating zones, which is a 2017 new tax law where Sean Parker lobbied for this in 2017 tax cuts. And it's really for stock traders. Hopefully a lot of people in this audience hopefully gets heard of it. Essentially, one of the only vehicles to defer the capital gains that you owe on the sale of stocks. So all over the place, lots of, and it's also generally not necessarily just in areas that you think are needing opportunity. There's like downtown San Jose, lots of like the new Googleplex is an opportunity zone. It's crazy. And so there's three major benefits of investing in opportunity zones. One is tax deferral. So say you sold $100 of stock, $50,000 of that was gains. You owe 20%, maybe more, maybe less on that $50,000. Instead of paying that tax, invest the $50,000 into an opportunity zone and defer it for 5 years, essentially, until the end of December 2026, pay on 2027 tax, reduce rate. So whatever you owe, reduce it by 10%. So remember, deferral, so you're getting a lot of benefits of just pushing it to the future. You're reducing it, another benefit. And then the final benefit is for all future capital gains within the property, you don't pay any taxes if you hold it for 10 years. And that window starts as soon as you put the money into a carve option fund. And this is eligible for sale of short-term and long-term capital gains, sale of businesses, sale of real estate. Most people who have real estate don't do OZs because they have 1031 exchanges, although sometimes it does make sense to do an OZ versus a 1031 exchange, especially if the profit margin isn't that much. I want to just deploy that into an OZ, keep the rest, and have ability to invest in whatever you want. So shifting, going back to shifting. So there's lots of ways to do shifting. And one thing I want to highlight that it's all about rearranging things, right? Your move, like Apple does this, they move from income from America to Ireland. You move active to passive through, doing long-term leases of your Airbnb. You move from long-term to short-term or vice versa. Opportunity now to later, opportunities on those 401ks. Consumption to expenses. The more you can make things an expense versus a consumption, the more tax favorable your living is. Pay your kids. Pay your kids $12,000 a year, and they don't pay taxes on the $12,000. Now you reduce your AGI by $12,000, and move after tax to pre-tax. So a lot is about shifting. There's lots of strategies about shifting. And finally, one last point about shifting is passive to active shifting, which is, we talk about moving things from active to passive. Why would you want to do this? It's because you've accumulated so many losses from your real estate that now you don't know what to do with it. And if you could work 50 hours and the majority of your hours in real estate, you could qualify for a real estate professional and essentially classify all your passive P&L, passive gains, losses, as an active loss or gain. And if you were working at, say, Apple, like I did last year, making, say, $500,000 like I did last year, and paying and having so many losses that if I could use it to write off my Apple income, that would be pretty good, right? But I could never qualify for a real estate professional. The government would never believe that me, as a person who's working at Apple, could be a real estate professional. But I don't have to. I could be married, filing jointly, and my wife is a real estate professional, and that counts. So I want to leave this quote here: 90% of all millionaires become so through owning real estate. And this is, of course, at a time when that was a much bigger deal. More money has been made in real estate than all industrial investments combined, and that continues to be the case. So hopefully you guys invest in real estate. Hopefully you guys understand why people love investing in real estate. I probably paid less than 4% overall on taxes on all my many millions of dollars of real estate income. But that's just my experience. I'm not a CPA. And if I was one, I'd probably pay nothing. And final quote: this makes me smart. I said the same thing when I was filling my taxes. I said, what's my taxable income? How much taxes did I pay? 0. So that is the presentation.
Thanks, Eng. That's tremendous. Thanks for walking us through that. I had a quick question, actually. And sorry, Stamp, I know you were going to MC the Q&A.
Sure, go for it.
Sorry if you don't want me to jump in the queue. I just want to actually just ask generally, maybe this is a good way to start the discussion. There are tremendous benefits to investing in real estate. What are some of the biggest problems that you see or traps that people do when they get started to try to obtain this level of tax efficiency?
I think most people don't go into real estate thinking about tax efficiencies. I think that should just be an added benefit. If you can make 5% cash and cash, that might sound terrible. But if you say that's tax-free, that might sound a little bit better. I think the drawbacks of investing in real estate is that you can make 5% cash and cash. You can also make 12%. You can also make native. And sometimes people convolute in real estate investing with real estate. It's not the same thing. Yeah. But I would highly recommend people just try real estate investing. I think that's something you can't learn until you do. And I did it when I was young, of course, at a different time, better economy to buy real estate, but that has helped me a lot.
Awesome. Thank you for that wonderful presentation. We're now going to open it up for questions, everyone. And if you have a question, just feel free to just unmute yourself and say it out loud. I know that Greg had a question right here. Do you want to ask it, Greg, or I can say it for you?
And thank you for the presentation. That was really good content. So I was wondering if you could share your experience or your thoughts around land conservation easements and or the alternative fee simple donation.
I just talked to my land conservation easement guy today. I do land easements. I have easements myself. And to explain to the audience what that is, essentially it's a charitable deduction of land at an implied higher value that essentially nets you typically 4 to 6x return on your investment in terms of a taxable write-off. So usually when you give it to a charity, say you give $1,000 to Habitat for Humanity, you can write off $1,000. In land conservation easements, you give him $1,000, you can now write off $5,000. Where this makes a lot of sense is if you're making a lot of money, typically around $300,000 and above. Now you're easily making ROIs of 100+%, and it caps out at half your AGI. So if you're making $1 million and you put in $100,000 into an easement, you get a $500,000 write-off. And now your taxable income, instead of $1 million, is $500,000. That top $500,000 is highly taxable. We're in a progressive tax system, highly marginal tax rates, right? Federal and state, if you're in California, that's ridiculous, nearly 50% more. And so you're saving $250,000 of taxes by putting $100 of a contribution, charitable contribution, into an easement, and getting that back within the first few months of the year when you file your taxes. There are risks to this. It is an audit risk, and I would advise you to look into it. I know people still do it, and the rich people still do it. So I like to follow what rich people do because they have more power than me, and I don't have as much power as them. So I'd rather just ride the coattails of those in power. And I know a lot of congressmen and senators do that too. I don't have any specific experience on fee simples. Sorry about that.
All right, we have another question from Baron. Baron and his wife are both W-2 employees, a high tax bracket. Is there any way to deduct this income without them being real estate professionals?
To deduct your W-2 income, which is what I assume you're asking, you can use a land conservation easement, which has no bearing on being a real estate professional or not. It's not even though it's sort of like real estate, it's sort of like you buying land, you're saying, I'm going to build this office park with this land in the middle of Tulsa, Oklahoma. That doesn't make sense, but it has an implied value of 5 times the value. So I'm going to donate that 5 times value and say, hey, I'm going to donate and make an easement perpetually, keeping it from develop and conserve it, and claim that higher implied value as a write-off. You can do that as a regular person, not real estate professional. You can invest in oil and gas, intangible oil drilling credits counts. You can get active losses against your active income as a 100% write-off. Now, whether you invest in like oil as an investment source, it's not a matter. But there's a few other ways to do this as well. It does help to have a business or side of business, helps to make your W-2 income, 1099 income. All these are very helpful. You control more on how you rearrange the facts. When you're a W-2 employee, you're kind of limited with how you can arrange your facts.
Awesome. We have a question from William. Can Eng talk about his framework for opportunity zones? His understanding is that there's a 10-year hold period.
There's a 10-year hold period, and that's probably my least favorite part of it. But essentially, you get like a 20% discount on your investment. Kind of got fucked up a lot to make it not great. Now, an opportunity zone will probably be of construction because there's a few ways to qualify it for opportunity zone. One of the ways is to do 100% material, or I don't know what it is. It's capital improvements on it, which typically means construction. Now you can do a redevelopment. You can have a house or an apartment building and gut the whole thing and renovate the whole thing. You can also buy just developed before opening. So that's another way to do it, but that's just sort of shift the timelines. Anyways, it's 10 years. You put in your deferred capital gains on the capital gains. You don't pay taxes for till 2027 essentially, and you pay 10% less taxes than you owed, and then all future capital gains and the depreciation recapture, which typically would happen if you don't do a 10-30 exchange and other deferrals, all gets eliminated after you hold for 10 years. So that's usually, I mean, that's the framework of almost all opportunity zones. So I'm not sure if that's like the answer you wanted.
Okay.
Awesome. Yeah, definitely. Thank you. That was very helpful.
Oh, I'm doing like 3 opportunity zones this year, and I have 1 open.
Nice. All right. Julie has a question next about why can't you have W-2 income and your own real estate business?
No, you can have W-2 income and your own real estate business. It's just different silos of income. Active income is this general pool of income. Think of it as a P&L, right? You have money you made, you have tax credits, you paid, with the new tax scheme, it's sort of very standard. So there's no, it's very few people use itemized deduction. I don't know if that's even a thing anymore. But usually you can deduct like your mortgage and other stuff, and that reduces your taxable income, but only your active. Passive is a whole other tranche bucket silo of it, and anything you make passively on real estate, you will be taxed as ordinary income, but all the losses that you make in real estate, which would be typically more than your gains, and this is, remember, not real losses. This is like fake losses, like paper losses, and this loss can only be used for that bucket of passive income.
Wait, but so just to double check. I'm also in I'm at Amazon, so big paycheck. Mm-hmm. Now I also have, I'm buying a commercial property, right? It's a business, it's, I own the business, et cetera. It's its own IRS number, whatnot. So my first year, I'm making sure, there's some profits, I'm collecting rents, but mostly it's all expenses, right? So it's losses. Don't losses then count as a deduction for my on my overall tax return?
It counts as a deduction if your other income is part of this business or overarching business. But because your Amazon income is siloed off, it does not mix. But what you can do is, if you have profits, hopefully you do have profits, is shift some of those expenses, daily expenses that's not tax deductible at all, this post-tax, and move it to this bucket. So then you slowly reduce it to 0, and at least use that advantage, right? Take some of the things that you'd use to pay for your own life to a reasonable extent. Go talk to your broker, have sushi, and that's like tax deductible. You made income, but you have expenses. Right? That's generally what it is.
Thanks.
Mm-hmm. Okay, we had a question via email. If you operate your real estate as an LLC, what are some strategies you can use to shift income or expenses?
LLC is more of an asset protection thing, more of a legal thing. Single member LLC is essentially a pass-through entity, which means it completely ignores the LLC as a structure. That means you might as well not set it up. It's more about asset protection. Like, do you want to contain it within a box that hosts all the liability, right? Limited liability corporation. But if it's a multi-member LLC, it then becomes its own container from a tax perspective as well. And I'm not sure if you're married, maybe if you can do that in some community property states. I'm not sure of the whole thing, but multi-member LLCs does create its own container. But I think your point is, what strategies can I do when I do an LLC? I think you can do almost any strategy without an LLC as with an LLC. It's a sole proprietorship, right? It's not a legal it's not a legal entity you created, but it's still a container of P&L. That's what you're trying to do. Trying to put expenses in that P&L to reduce your profits to zero.
Awesome, thank you. Another question via email. If you're a limited partner in a syndicate, in a real estate syndicate, can you still take advantage of depreciation or any other of the tax benefits?
Yeah, so if you're a limited partner, so in one of my syndicates, we're issuing K1s right now. And so for someone who invests $100,000 and they made $12,000 that tax year, 2020, we're issuing a K1 where they'll see a $47,000 loss, even though we gave them $12,000. That loss is, essentially that $12,000 is with no withholding because we don't know what the expenses at the end of the year, and that loss then goes for the next year as well. So you're a limited partner, you still get K1, and that's the imperative thing, right? You're a partner, which means you're a co-owner, direct owner of an asset. REITs aren't partnerships, they're not ownerships. That's why you don't get a K1, you get 1099. Actually, I don't know what you get. But you don't get the same tax benefits.
Awesome, thank you. Any other questions for Eng?
Hey, and this is Dewey. Thanks for the awesome slide. I'm a visual learner, so that was really helpful. I consider myself a tax noob, so because it's in a scary realm that I don't understand. So question for you, I guess lessons learned from, let's say if you're in my position 10, 15 years, whatever so ago, what would you say that would be a benefit to, either read or what would you have done that's different to further improve yourself 15 years ago, like things that you thought, I should have done that a long time ago when learning about taxes, or talk to the right person, get in with the right groups. I'm happy that I'm on this phone call today. This is great. But like I said, I wish I'd seen this like 5-6 years ago, even 10 years ago, right?
Yeah. I think for a lot of people, you're so busy with your lives, right? You got so many things going on. You're attending these forums, hopefully to educate yourself, but you're generally just so busy with your jobs, and you don't have time for this. I went to Wharton. I studied accounting and corporate and derivatives and did all the whole math and everything. I didn't learn any of this stuff. This is personal economics. No one teaches personal economics. So it is a little bit about the experience. My advice, not necessarily tax advice, is more about understanding your capital, understanding your cost of capital, and optimizing your cost of capital. I wish I could have leveraged earlier and more often. I wish I never took a 30-year fixed loan. That was ridiculous, because if you pay down after 10 years, probably going to refinance again and cash out refi. If think of capital as a precious source. It's power. It's what's going to get you to retirement, financial freedom. You want to nurture that capital and optimize it. If your capital is making zero in a bank and you're over-indexing cash, potentially invest it, obviously, within reason, safety. And then if your capital is in your house and you're getting essentially 3.5% because that's what your mortgage is, maybe don't do that and take a cash HELOC and then put into another thing. Now that's a little bit maybe over leveraged, but the same concept applies. Shifting capital and making it yield higher returns is essentially what all Wall Street does. That's what Wall Street does, just moving capital around from poor performing assets to high performing assets. You guys should understand every asset that you have as an individual and try shifting it around. Credit card debt to savings, and then shift that around to savings to then rental incomes or syndications, etc.
Thanks for that.
I got a quick question.
Mm-hmm.
Thanks for the presentation, by the way. So I was just curious, how would you say, like, I guess this is more like down the line, if you were to pass down, I guess, your assets and like your real estate properties to, say, your kids, how would you say that the most, I guess, efficient way to kind of do that? And
You probably want to trust, and I'm not that specialized in that part, but you probably want to put in a trust, and so that you avoid probate. From a fair market value adjustment basis, that happens naturally. You got to report that. I've never experienced it myself, but that's what CPAs have told me. One of the things here is essentially, take this example: you bought something for $100,000. You depreciate $50,000 of depreciation. So those potentially tax reductions, right? Depreciation is a tax deduction against passive income. And now you sell it for $200,000. You carry that $50,000 tax basis, cost basis, because you bought it for 100, but you depreciate to 50,000. So now the cost basis is 50. You buy 200,000, and you take a $50,000 cost basis. If you ever sold it, you owe $150,000 of taxes. Keep doing that, and your cost basis is now zero. And maybe it's now you have $1 million property in like 4 exchanges after. It's better to even just have a bigger property start. That's why you always want to start as big as possible. But all that carry forward of cost basis and depreciation can and should always be mitigated. And obviously this route tax is $11 million. Hopefully you guys will have that challenge someday.
To add through that, you can talk to a estate planning attorney who can help you with that type of planning.
Mm-hmm.
Jesse had a question. Have you experienced for tax benefits by using real estate to go into nonprofit or other operations?
So what you're trying to ask is, do I have experience using tax benefits for nonprofits, really? Because nonprofits, you can actually, are you talking about setting your own 503B? Sure.
Yes. So like I own property right now.
Mm-hmm.
And I'm just wondering, like, as far as where I want to take it, like as far as like going into more properties or just like nonprofits, because I know with nonprofits you can also do government write-offs as far as that, and then also creating that as like your active income.
Mm-hmm.
I was just wondering if you had any experience in that field.
Unfortunately, I don't. I do know several friends who operate nonprofits, mostly for tax write-offs. But that's mostly about flowing all their expenses, right? Their New York Manhattan apartment is in the name of a charity, and they get tax write-off on that. It's great, these guys. But I don't have any experience with that. I think I would, to answer your question, it's more about understanding you, Jesse, on like what your goals are. If it's trying to make as much money as possible, I would just keep that in mind and ignore the taxes, because that will come. The taxes will come when you invest in real estate. Try to make as much money as possible, optimize your yield and your growth and your cash flow, because appreciation is great, but there's no cash flow to defer. So there's no tax advantage, right? You're deferring depreciation to the future, which essentially deferring appreciation or capital gains to the future. So then, no benefit. Obviously, sometimes construction projects are very lucrative. I have several myself. That's what option zones are. But try to go for cash flow if you can.
Thank you.
Awesome. Baron wanted to clarify his earlier question. To clarify, K1 expenses can't be deducted from W2 income since that is a different silo, for example, the Amazon example, and it's unrelated to property income.
Yeah, so it unfortunately is not, if you're a W employee, it's just such a limited space to be in. There's other ways to, you essentially have to convert your W2 income to 1099 income if possible, which then, I don't know, if you probably lose out on RSU, so why bother? But there's other ways to essentially create like a business. You can have losses. You can use some of those losses for 3 years. That's generally that's not really a tax strategy. W2 income is just generally hard. I think land conservation easements is one easy way to do it, risky from an audit perspective. And then marrying a real estate professional. Or if you have very unequal compensation, maybe just have one of you guys, if you retire or go become a real estate professional, which is a conversation I had with my wife, said, hey, babe, if you leave your job, we actually make more money. I said, I can make more money, and that's great. So that was the conversation I had, and that's what we did. Someone should make an app for a real estate professional where someone essentially, if you're a really rich person, I want to marry a rich professional so I can not pay taxes. Although if you're really rich, you're probably in Puerto Rico.
That's true. Actually, a quick question on that. I've heard of individuals creating pass-through entities for W-2 income. Now, I don't know if that's recommended or not, but I was curious if you had any thoughts on that.
There's all kinds of ways to go in the gray area. This isn't being recorded. And I like to not say, like, I talk to a tax professional because, yes, they just read the book. This is like what I found people have done. There are some people who do that. There's lots of gray area stuff. Not gray area, it's like arm's length. Like you could, when you buy a house, you could like buy it on an LLC, they rent it to yourself. Now you have, especially if it's an expensive house, now you get over the SALT limit deductions because for rental income, you can deduct all the interest, right? So if usually $750,000 of interest, if you buy $5 million house, now you can deduct everything from interest and then depreciate it and then rent it yourself. That rental income could be a loss as well. But then it's all about containers, and these containers that you flow P&L into. That's what Apple is, right? Apple has its own P&L. It then flows into a subsidiary holding company. That status, that's income status, it has very low rates in Ireland, less than 1% of tax rate. These are kind of things that big corporations do. You could have your own holding company. I have for myself. And essentially, as long as I never get the cash, I can not pay taxes on it. But then I have to keep reinvesting it or doing something with it with some implied future determination. And of course, I'm at that point in my life that I can, and I have the luxury to do so. But I think it all starts with having capital and abundance of returns that you can write off.
Yeah. In other words, having an LLC has a lot of advantages if you plan on deploying capital or owning assets.
Having an LLC or a S corp potentially better. But containerizing it, right? It's creating a container and a P&L statement. A single member LLC does not do that. It's a pass-through entity. The taxes is you. You file one tax. If I have a multi-member LLC or an S corp or a C corp, it don't hold appreciating assets in C corps like real estate. These entities are containers. They create another container, another P&L that goes off your books. And then you can start playing a little shifting around and doing other stuff. It's up to you guys.
We have a question from David Kuhn. Would K1 losses offset stock gains?
No, unfortunately, stock gains are usually classified as another silo of portfolio income. So 3 silos. Unless you invest those in capital opportunity zones. but the decay was not going to happen. Really.
Any other questions for Eng? Let's find all the loopholes.
Yes, I know all the loopholes. You got to ask me very specifically because if it's like, if you buy a boat, so many loopholes buying a boat. Don't buy a boat though. Not getting used to it. You can buy partial jet. This is something that someone has pitched me recently. Think of the depreciation thing. Yeah, but it's like $2,000 an hour to use a jet. Okay. I like to travel Southwest. I'm very cheap still. Yeah, I'm not there yet.
Hey,
yeah.
a quick question. Have you seen or has this have experience with, like, I guess experience with like tax shelters and stuff to, I guess, yeah, like avoid taxes or pay less taxes?
Well, essentially everything we talk about is the tax shelter, right? A tax shelter is really about either shifting things to a lower tax state, meaning out of country, Cayman Islands, other stuff. You're shifting income, right? Saying, hey, I didn't make this income. I had this much losses. Someone gives me an invoice. I now have losses. And this invoice creates profits, but that profit is created in a tax shelter, potentially another state, another entity, just off your books, and now someone else's problem, and potentially a lower tax rate. If you shift taxes around in this progressive tax systems, then you can also have the same income, total income, and pay less overall taxes if every one of these entities are separate from each other, which you can get away with corporations. But beyond that, I mean, there's a lot of tax shelters, but mostly, you know, a lot of it's going to be more complicated than it's worth. If I would say if you're making more than $1 million, then you start thinking about these things seriously. If you're making like $500,000, then you don't really, I don't think it's worth it. Maybe land comes from easement. You're making $100,000 or less, then start making more money. Invest in real estate.
Well, we're coming on 10 o'clock, Sam. What do you think about maybe giving folks an opportunity or actually an opportunity to kind of close out, or, you know, I just want to make sure I'm respectful of everyone's time. So what do you think?
Yeah, let's take these two last questions and then we can close out and everyone can network and can close out his talk as well.
The last question is from Baron. Is that what you're saying?
Yeah, from Baron, and I got a private one, which I will share now.
Ooh.
Yes, and Baron, you definitely, I definitely have convinced many people to quit their jobs to become real estate professionals if you have unequal incomes, very unequal, like $500,000 versus like 150,000. You're gonna make so much money from you creating. So amazing. But the other thing is that you have to have losses, right? Like obviously, if you create, it's like not going to help unless you have losses. So invest in real estate, get the bonus depreciation, get the cost segregation study, do all that stuff. Invest in syndications, and tender exchange. Baron's last question is, how do you manage your early investments since you're out of state? Property manager. It was my dad. I got lucky. He lived in LA. I would probably advise, and this is my situation, I would probably advise not buying property that you have to manage. If you have to manage it, then you're not valuing your time. Everything you do in life, whether it's investing in real estate or starting a bakery, if you can't have it make money without your direct involvement from a day-to-day, then it's not an investable asset. Then you shouldn't be investing your time and energy into it. It's a hobby. It's a job. Don't get yourself another job, guys. Get yourself an investment. And always calculate that property management fee into it. How to identify property managers, probably through referrals. Don't buy single family or multifamily in California for sure, or generally blue states if possible. And buy bigger, you know, scaling is always better. A guy who's working at a shitty companies probably want to look at the best companies. Same thing if he's working on a fourplex or a single family and managing 100 single families. It's a lot of work. I just manage 100-unit Class B property and just walk the doors and manage it easily there. So anyone worth a salt usually goes up in scale, and the cost percentages usually go down as well as the variable cost goes down. The biggest thing also when starting real estate is think about variance. And that's why I like scale, and that's why I like syndications. But of course, I'm going to pitch that to you. If you have a bad experience with a single family or fourplex, and you have one tenant that sucks and it's killing you, then you got 100% vacancy or 25% vacancy. That will kill your cash flow. And it also will kill your experience with real estate. And that's the last thing I want you guys to have happen. Don't have bad experiences, or at least be persistent through those bad experiences. When you often hear people who talk shit about real estate investing, is because they had that initial bad experience. And it's a hit or miss sometimes. Usually, for the most part, you get a good experience. But in general, that's one of the reasons why I don't like the smaller stuff. Like, if it's like you're buying a triplex or condo or whatever, are you gonna buy 100 of those? Because the first iPhones can be expensive to make. The millionth iPhones can be cheap. Do things at scale. Do things that you want to know that you will do for the rest of your life. And ideally, that's wrapped up in investing. Be an investor. Learn to invest. Invest in your own properties actively. Invest in syndications. Invest in stock market, whatever it is. That's going to be a muscle that you repeat and use over time. And then don't pay taxes.
Very nice, Eng. Tremendous. Well, I'm glad. Go ahead, Sean.
One final question.
One more. Okay.
That's a good closing note.
I know.
That was a nice.
I liked it. I liked it.
I could think of a whole new
I know. It's okay. This one's an easy one for you. What types of professionals do you think are really important to hire? What does your team of professionals look like? And do you have a CPA that specializes in real estate and trusted attorney, etc.?
I think as tax professional is probably the most important one of like asset protection. Trust is slightly different. Tax professional is something that you should look for, and that is also an active in what you are doing. What I mean by that is if you hire a CPA, make sure he's or she is a real estate investor. It's something that does essentially what you are doing and has a implicit need and desire to reduce his or her own taxes, and will share those things, right? I'm sharing this to you because I have a very big need to not pay taxes. I don't like paying taxes. I want to pay my fair share of taxes through the legal process known through the tax code, which is they encourage investing. And so you will always get better advice from people who have a baked in direct correlation to what you're doing, or direct action what you're doing. That will always be the case. And then also for me, having CPA is mostly about having somebody sign on the forms and okay, I got arm's length, plausible deniability.
Very cool.
Awesome.
Anything else?
Those are all the questions.
Very cool. Maybe Eng, we can enlist your your superior knowledge to do actual AIN syndicate, perhaps in real estate. That might be interesting.
I'm happy to do one. You should do a Reg A fund, and then now you can like test the waters, and it's a little expensive to set up, 6 months, but you can get like 500. Now you can pay against Fundrise. Then we should make a Fundrise app and do it better than them. Their investments suck.
You know what? A lot of things are on the table right now. Let's just say that. Fantastic. Well, I'm heartened by the attendance today, also the questions, and also the content today. So thank you so much, everyone, for joining. We're going to record. We've recorded this. We will post it on YouTube. Feel free to share, like, and subscribe, as they say. I feel like a YouTuber. And I think that is a nice little bow on top to kind of close it out. Do we want to leave 30 minutes for socializing as well, or are we good? I just maybe Sam, you had an idea on that. Feel free to.
Sure. Yeah. Are there any final thoughts you want to share, Eng, with the group? It's open season.
Oh, just final thoughts for those who, hopefully I'll get everyone's email and send my personal email. I didn't highlight it there. I will, I will share. I do a lot of tax talks. I've talked at Amazon, Facebook, Apple, and I really think of it from I used to pay a lot of taxes perspective of being a high-paying person in one of these companies. So hopefully you guys can reach out. See, I have a couple stuff on YouTube, but I also have investments, right? I usually have 2 deals a month. We just closed on Opening Zone. We're doing 3 more in the next few weeks. Big thing about Opening Zone is just one last thing. I forgot to say it. If you sold stocks from as far back as October 4th, October 5th of 2019, and you have a huge amount of capital gains, and you think your window of investing is over, which is usually 180 days, you're wrong. An IRS news section said that you can invest up until March 31st of this year from those gains as far back as a year and a half ago, essentially, and defer. So all of 2020 counts. The last quarter of 2019 also counts. If you made gains and you pay taxes on them, file an amendment, don't pay those taxes, get the taxes back. Or when you're filing taxes for 2020, use that and then defer. So you have March 31st.